Think your state pension is completely tax-free? You might want to think again. For millions of retirees, an unexpected bill from HMRC is becoming a very harsh reality. So today, we're going to break down exactly why this is happening, and more importantly, what you can do about it.
This entire discussion has been put together for you by the experts at My Tax Accountant. They're all about making these tricky tax topics super clear and manageable for everyone. So let's dive right in.
So is the state pension a tax trap? Well, for a whole lot of people, the answer is a shocking yes. Many are finding out for the first time that this income isn't automatically tax-free. And it leads to these confusing and, let's be honest, pretty stressful bills landing on the doormat.
So here's what we're going to cover. We'll look at just how big this problem is. We'll explain why your pension is taxed in the first place, see how HMRC gets the money, point out the common mistakes to avoid, share some smart ways to cut your bill, and then we'll wrap it all up. All right, first up, let's get our heads around this hidden tax trap that's catching more and more pensioners by surprise every single year. Just look at that number. By the 2025/26 tax year, a massive 8.72 million pensioners are expected to be paying income tax. Now, to put that into perspective, that's up from just 4.9 million about a decade ago. This isn't some small issue anymore. It's fast becoming the new normal for retirees.
And it's not just us saying this. This quote from the Office for Tax Simplification hits the nail on the head. There's this huge gap in understanding. So many people have no idea it's taxable, and even those who do often feel, that it's just not fair. That confusion is exactly what we're here to sort out.
Okay, so let's get to the big question. Why on earth is the state pension taxed in the first place? Really understanding this is the key to managing it. So, here's the bottom line. As far as HMRC is concerned, your state pension is just another source of taxable income. It's treated in the exact same way as a salary from your job. It all gets added together to give you a total income figure for the year.
Now, this is where the penny really drops for most people. For the 2025/26 tax year, the full new state pension comes in at just over £11,500. But the tax-free personal allowance, the amount you can earn before paying any tax, is frozen at $12,570. You can see the pension by itself uses up nearly all of that allowance, leaving you with barely £1,000 of wiggle room for any other income before tax kicks in.
And once your total income tips over that £12,570 allowance, well, that's when you start paying tax. For most pensioners, any money they get on top of that, from a private pension, some savings, maybe a little part-time job, is going to be taxed at that 20% basic rate.
And here's a little did you know for you, and honestly, this is the part that trips everyone up. Unlike your old salary, the Department for Work and Pensions pays your state pension gross. That means they give you the full amount with zero tax taken off. This is the main reason so many people think it's tax-free. It means HMRC has to find other ways to collect the tax you owe.
Which leads us perfectly to our next section. So if the tax isn't taken off before you get the money, how does HMRC actually get it? Well, they have three main methods they use. So, these are the three main tools in HMRC's toolbox. First, there's PAE on another income, like a company pension. Second is self-assessment, which you might already be familiar with. And the third is something called simple assessment, where HMRC just sends you a bill. Let's make this real with a couple of examples.
Okay, let's meet Donald. His situation is really common. He gets a private pension from his old job, and he also gets his state pension.
So how does Donald's tax work? Well, let's do the maths. His total income is £20,500. Take away his £12,570 tax-free allowance, and that leaves £7,930 that's taxable. At 20%, his total tax bill for the year is £1,586. Now, to collect this, HMRC simply adjusts the tax code on his company pension so that money gets deducted automatically, bit by bit, throughout the year. Simple.
Now let's look at Penny. Her situation is a bit different. Her state pension is her only income, and it's just a little bit over that tax-free allowance. Because Penny doesn't have another income source for HMRC to use the PAE system on, they use the simple assessment method instead. So after the tax year ends, they'll do the calculation and see she owes tax on £930 of her income. At 20%, that's a bill for 186 quid, which they'll send her in the post to be paid by the following January.
Right, so now we know how this system is supposed to work. But let's be real, things don't always go smoothly. Let's talk about the common pitfalls that can easily catch you out.
The biggest issue right now is something called fiscal drag.
It sounds technical, but the idea is simple. The government's triple lock means the state pension goes up each year, but the tax-free allowance is frozen solid until 2028. This basically acts like a stealth tax. As your pension goes up but the threshold stays put, more and more of your money gets dragged over the line into the tax system.
Pitfall number 1 is the classic, an incorrect tax code. This is the little code HMRC sends to your pension provider. If it's wrong, you could end up overpaying tax and being out of pocket, or worse, underpaying and getting hit with a surprise bill later. Just take a look at what happened to Idris.
So, Idris's pension provider made a simple mistake and was using the wrong tax code. He was paying too much tax every single month. Thankfully, he was on the ball, checked his paperwork, spotted the error, and got on the phone to HMRC. They sorted it out and refunded him the £320 he'd overpaid.
And here is a massive pro tip for you. Never, ever, just assume your tax code is correct. You can check it yourself anytime you want using your personal tax account on the government's website. It's especially important to have a look at the start of the new tax year in April, because that's when things often change.
Okay, pitfall number 2 is a real shocker, and it's called emergency tax. This often catches people when they take their first big, flexible payment from a private pension. The HMRC system sometimes assumes you're going to get that same huge payment every single month, so it slaps you with an emergency code and takes way, way too much tax.
Now, if this happens to you, the first rule is do not panic. The money isn't gone forever. You can get it back, and pretty quickly too. Just check your pension statement, find the right form online. It's usually the P55 form, and send it off to HMRC. They're usually pretty good at processing these, and aim to get the refund back in your bank account within about 30 days.
All right, that's enough about the problems. Let's flip this around and talk about the solutions. There are plenty of perfectly legal, smart ways you can take back control and lower your tax bill in retirement.
Here are 4 of the big ones. You've got the marriage allowance, making more pension contributions, using gift aid for your charity donations, and of course, using tax-free savings accounts like ISAs.
Let's zoom in on the marriage allowance, because for retired couples, this can be a real game changer. If one of you isn't using up all of your personal allowance, you can transfer a chunk of it over to your spouse or civil partner. This little move can cut their tax bill by up to £252 a year.
And get this, here's another brilliant pro tip for you. If you realize you've been eligible for the marriage allowance, but you just never got around to claiming it, you can backdate our claim for up to 4 previous tax years. That could mean a lovely tax refund of over £1,000 landing in your account. It's absolutely worth a few minutes of your time to check.
Whew! Okay, we have covered a ton of information. So let's bring it all together, summarize the most important bits, and talk about your next steps for a tax-savvy retirement.
So, if you remember nothing else from today, remember this. Your state pension is taxable. It uses up most of your tax-free allowance. HMRC will collect the tax from your other income or send you a bill. And that is why you must always check your tax code and use every allowance you can, like the marriage allowance, to keep that bill as low as possible.
Look, I get it. If your head's spinning a little after all that, that is totally okay. Pension tax can be genuinely complicated, but the good news is you absolutely do not have to try and figure it all out on your own.
For professional one-on-one advice that's tailored to your exact situation, the team at My Tax Accountant is there to help. They can give you clarity, peace of mind, and make sure you're not paying a single penny more in tax than you legally have to.
And getting in touch is easy. You can call them or just send a WhatsApp message to 07854 255 375. Or, if you prefer, you can drop them an email at info@mytaxaccountant.co.uk. Please don't hesitate to reach out.
And one last thing, for more helpful guides just like this one, make sure you hit that subscribe button on the My Tax Accountant YouTube channel. Because at the end of the day, understanding your pension tax isn't just about saving a bit of cash, it's about making sure your retirement is as comfortable and secure as you always planned it to be. So are you doing everything you can to protect yours?